Hi, in the last video I mentioned about accounting for intangible assets. In this video I'll explain about accounting for inventories.
There are two types of entities for which the accounting for inventories is relevant. The merchandising entities, that is retailer, dealer, wholesaler or distributor, that purchases inventory for the purpose of resale to its customers, and the manufacturer who buys raw material, process these materials using labor and equipment into finished goods that are then sold to its customers. For both these entities, the issues faced are: at what point of time should the items be included in inventories? What cost should be included in the valuation of inventories? What cost flow assumption should be used? And at what value should inventories be reported in financial statements? This video consists of history of IS2, objective of IS2, measurement of inventories, cost, net realizable value, recognition of an expense, and disclosures.
This standard was issued originally in October 1975. Then it was called as IAS2 Valuation and Presentation of Inventories in the Context of Historical Cost System. Then this standard was revised in December 1993 and replaced by new standard IAS2 Inventories. In 2001, ISB adopted IAS2 as part of IFRS. Then in 2003, ISB revised IAS2. After that, there were some minor amendments to the standard. The objective of the standard IS2 is to prescribe the accounting treatment for inventories, and the standard also provides guidance on how to determine cost and subsequent recognition of carrying amount of inventory as expense, including any write down to NRV, and also the cost formulas that are to be used to assign cost to inventories. Definition of inventory. What items will be called as inventories? The definition that is given in the standard is that inventories are assets held for sale in the ordinary course of business, or in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process or in the rendering of services. If you hold any inventory for sale in the ordinary course of business, if you hold any asset for sale in the ordinary course of business, then that asset is called as inventory. If you are a manufacturing company, the finished goods that you produce are held for sale. If you are a trader, the goods that you buy are held for sale in the ordinary course of business. So these two items will be called as inventories. If you are a manufacturer, you buy raw materials, you use the raw materials to produce finished goods. When during the process of conversion of raw material to finished goods, you have some items in the process of production called work in progress. So the work in progress is also called as inventory, and the raw materials are also called as inventory. And if you are a service provider, and if you hold any material to be used in the provision of services, then that material also will be called as inventories. So inventories include goods produced or to be produced by the entity for purpose of sale, or goods purchased for resale, such as merchandise purchased by retailer, and also goods include land and other property held for resale. Measurement of inventory. IS2 prescribes that inventory should be measured at cost or net realizable value, whichever is lower. So here we need two things: cost and net realizable value. So what is cost? Cost consists of purchase cost, conversion cost, and other cost. Cost of inventory consists of purchase cost, conversion cost, and other cost. So what comes under purchase cost? If you purchase some inventory, then the purchase price that you pay should be forming part of the cost of the inventory. So if you purchase, you may get some trade discounts. Those trade discounts should not be considered. They should be excluded from the cost. And you pay some taxes. If the taxes are non-refundable, then it should be included in the cost. If they are refundable, they should not be included. And you incur some freight and transportation charges, loading and unloading charges you incur. Those also will be considered as purchase cost. You might incur some other cost. If you're a manufacturing company, you incur some cost to convert raw material into finished goods. So those conversion costs also will be considered as cost of inventory. For example, during the production process, you might incur some expenditure toward labor charges. You pay salary, wages to factory workers, and you incur some factory overheads like factory rent, depreciation of plant and machinery used in producing the inventory, and power consumption. All those will be considered as cost of. This standard mentioned that any production overheads that you incur in converting materials into finished goods, those overheads should be allocated over the cost of the inventory. So the allocation will happen. If it is fixed overheads, you need to allocate over normal capacity. So what is normal capacity? It is nothing but average production that you make, average production that you made over a period of years. So normal capacity is production expected to be achieved on average over number of periods. So you might take last 5 years or 10 years data into consideration and take the average production. So based on the average production, you will allocate the fixed overheads incurred in the factory. But in case of variable overheads, you will allocate it based on actual usage. Sometimes you during the production process, two products come from same process, or sometimes you may get some byproduct. For example, in case of sugar manufacturing, you might get some byproduct called molasses, and also you might get some other product like bagasse. Bagasse may be considered as joint product. So how to differentiate between joint product and byproduct? If the value of two products are significant, then two products are called joint products. If your value of one product is less than another product, then it may be called as byproduct. So this standard mentioned that you need to allocate the cost incurred in producing the joint products under some basis. So the basis will be either you take market value at the point of separation. If it is two products come from one process, there will be some point where there will be these two items will be separated. At the point of separation, you can take market value as a basis to allocate the cost incurred. If it is a byproduct, you take the net realizable value of the byproduct and reduce the cost of the asset. There are some other costs that are included in the cost of inventories. They are included only when they are incurred in bringing the inventories to the present location and condition. For example, you may include some production overheads that are incurred at office. Say some office worker is working, say some office staff is working for factory. Like they're keeping the data of the factory, they're coordinating with the people in the factory. So that cost incurred may be taken as production cost. Or sometimes you incur some cost on designing products for specific customers. Some specific customer comes to you and they ask to modify the design of the product. So any cost incurred for designing will also be considered as cost of conversion, and we will take it as cost of inventory. But there are some costs that should be excluded from the cost of inventory. Those costs are abnormal amounts of wasted materials. So abnormal wastage should not be considered. Storage cost. Normally we will not consider storage cost as cost of inventory, but if that cost is incurred in the production process prior to further production stage. For example, if you buy raw material and there is some time gap for you to produce finished goods, you may take some 1 month time to start the production. So during that 1 month time, you might store the raw material in factory. So if you are storing the raw material in factory, that storage cost also will be considered as cost of production, cost of inventory. But if the storage cost is incurred after manufacturing finished goods, that cost will not be considered as cost of inventory. That cost should be excluded. That should be written off as an expense. Also, you might incur some administration overheads that do not contribute to bringing the inventory to the present location. All those administration overheads should not be considered, and even selling cost should not be considered. What about borrowing cost? Sometimes you incur some borrowing cost. You might borrow some money and buy materials to produce finished goods. So for that borrowing, you might pay some interest. If you are paying interest, that interest will be considered as borrowing cost. Whether that borrowing cost should be considered as cost of inventory. For this, we need to refer to IS 23 borrowing cost. IS 23 says that if inventories take substantial period of time, for this the standard mentioned IS 23 mentioned that if inventory is a qualified asset, So what is qualified asset? If inventories take substantial period of time to bring them to a saleable condition, then it can be considered as qualified asset. And any borrowing cost, any interest that you pay for that inventory production should be considered as borrowing cost. For example, take the case of production of wine from grapes. It takes a substantial period of time to produce wine from grapes. It may sometimes take years. So any interest that you pay during these years should be considered as cost of inventory. Also, sometimes you purchase inventory on a deferred settlement basis. That means you buy inventory today, you will pay after 1 year or 2 years. So there's a time gap. If time value is material, you should take the present value of the consideration as a cost, and any difference between the present value and actual payment should be taken as interest expense. Techniques for measurement of cost. There are some techniques to measure the cost. If inventory is not ordinarily interchangeable, you will measure the cost incurred under a specific identification method. If inventory is ordinarily interchangeable, you might follow some methods called FIFO or weighted average method or standard cost or retail price. See, in a cool drink manufacturing company, cool drink will be manufactured every day. So inventory, if you see one item today, it may not be there after 2 days. It might be replaced by another item. So if inventory is ordinarily interchangeable, we use some methods called FIFO, weighted average, or some non-historical methods like standard cost, retail price. But if inventory is not ordinarily interchangeable, that means it may take some 6 months time to produce one particular item. Say for example, furniture. Furniture we can see today after 1 week also it will be there. So if inventory is not ordinarily interchangeable, then we know whatever cost incurred on that inventory, that you will take it as cost of inventory. But if it is ordinarily interchangeable, we don't know at what point of time it is manufactured or what cost actually incurred to produce that inventory. So we follow under some assumptions, some methods, FIFO, weighted average, standard cost to retail price. Under FIFO method, we take we follow the assumption that any goods that are manufactured first are taken out of the company or sold, and only those manufactured later are in on hand. So inventory value will be considered on in that basis. If it is weighted average method, we take the average cost of inventory produced during the year divided by number of units, then you will get cost per unit, that will be taken as cost of inventory. If it is standard costing, we'll fix some standard costing under standard costing principles. Normally we will not consider standard costing, but if standard costing is similar to actual cost, is near to actual cost, then we can take standard costing as a base. There is one more method called retail price method. This is used in retail trade, where small scale traders, they don't maintain records of inventory. So they follow one assumption that they take the sale price of inventory. They know how much gross profit they will get as profit from selling the inventory. So from the sale price they will deduct the gross profit. The residual, that is considered as cost of the inventory. The difference between sale price and gross profit will be taken as cost of inventory. But under any circumstances, you should not follow LIFO as a method, because LIFO is not permitted by IAS2. That is about the measurement of cost. Now I talk about measurement of net realizable value. Sometimes inventory cost may not be recoverable if they are damaged. If inventory is damaged, whatever money you spent may not be recoverable, or it may become obsolete. There is a change in technology or change in fashion, so our product may not be liked by people, or sometimes selling prices might decline below cost, so we may not recover the cost of inventory. In that case, we need to measure inventories at net realizable value. The standard has mentioned that net realizable value is nothing but estimated selling price less cost to complete the cost to sell. So if you take finished goods, net realizable value is nothing but estimated selling price, and cost to complete will be nothing because finished goods are already complete. So for finished goods, we will take only estimated selling price and cost to sell. If it is work in progress, we will take estimated selling price and cost to complete and cost to sell to calculate NRV. If it is raw material, we take Replacement cost as the basis for raw material. In case of raw material, first we will consider whether the finished goods that are produced by using this raw material are sold above cost. That means they are sold at profit. In that case, we will measure raw material at cost irrespective of net realizable value. If if finished goods are sold below cost, that means finished goods are measured at NRV. Then raw material should also be measured at cost or NRV, whichever is lower. In this case, replacement cost is best measure of NRV. How to calculate write down to NRV? How to make write down to NRV? Inventories are reduced to NRV when they are lower than cost, and that calculation is made on item by item basis. We should not go by total value of inventory, total cost of inventory, and total realizable value of inventory and compare it. We should not do that. We can club some inventories which are similar as a group and then compare cost with NRV. If NRV is lower, we will book a loss. Please note that this write down is not permanent. This can be reversed when there is new information. Firm sales. You might enter into one contract in which the contract price is fixed and you might fix the quantity to be delivered. In that case, if you have any inventory on hand for which you know the cost, for this inventory you will take NRV from the agreement, not from the market price. If there is no such agreement, then we'll take market price. If there is any agreement, say for example you have entered into to sell some 100 goods at 100 rupees, so total you will expect some 10,000, but during manufacturing your cost has increased much that now cost per unit is 120. You manufactured some 50 units at 120 rupees, but whereas your selling price is only 100, you have to sell definitely 100 units at 100 rupees, but your cost of producing 50 units are 120. So in this case, cost is more than the selling price which is fixed in the contract. So for this 50 units, you need to take the selling price from the contract as NRV and book loss, because you entered into agreement for 100 units and you produce only 50 units. If you produce 150 units, under that 150 you have to supply 100 units to the seller at 100 rupees. So for first 100 units you will take the NRV from the agreement. For the remaining 50 units you take the NRV from market. Reversal of write down. We can reverse the write down of inventory when there is clear evidence that increase in net realizable value because of change in circumstances. We should show the evidence that there is increase in NRV above cost. In that case, we can reverse the write down of NRV. Recognition as an expense in profit and loss. When should we recognize the carrying amount of inventory in P&L? When we sell the inventory and revenue is recognized, that point of time we will take the carrying amount of inventory as expense in P&L. When will we take the write down of inventory to NRV? How to show? The standard mentioned that the amount of write down of inventory shall be recognized as an expense in the period in which the write down occurs. So when you are calculating cost or NRV, if NRV is lower, then the difference should be taken to P&L as expense in the period of write down. And if there is any reversal of write down, that reversal should not be considered as income, that should be considered as reduction of expense from the carrying amount of inventory during the period in which the reversal occurs. Disclosures. This standard has mentioned that you need to disclose accounting policies adopted in measuring inventory. What policies that you adopted in measuring inventory? What is the total carrying amount of inventory? And you need to classify inventory as raw materials, work in progress, finished goods, stock in trade. If you have, what is the amount of inventory recognized as expense during the period, you should disclose that. And also you should disclose the write down of inventories, amount of write down, any reversal of that write down, and what are the events that led to reversal of write down, you should disclose that. Thank you.